to Guy Bauer at tradingcourses.com for arranging the session today. Some of you may know Jigsaw Trading and some of you are learning about us for the first time. Today, Jigsaw's founder, Peter Davies, will discuss our order flow software and how it can benefit you and where you can go to learn more. Peter?
Sean? Okay, so what I'd like to do today is take a look at the benefits of using order flow in trading. Now, for some of you know Guy Bauer that runs trading courses. I've known Guy for a few years and we have a common interest in using order flow in trading. When I first met Guy, he was actually teaching the prop traders at a trading firm in Australia. And so we kind of have a common interest in this, and that's really how we got together and became friends. Now, in previous introductory webinars, we focused both on the order flow theory and the practical application of order flow theory, and that's been a bit much for many people. So today we're going to focus just on the practical side. Now, for those of you that are interested in the theory of order flow, which will help your understanding of trading in general, of the mechanics of price movement and why order flow is relevant, then please go and check out the free Introduction to Order Flow video on the Jigsaw website. Now, before I start, those who don't know us probably want to know, who is Jigsaw and why might we be worth listening to. Now, for those who don't know it, this site here, investimonials.com, is an independent review site with over 10,000 companies and products reviewed. Now, there is a risk for us in listing on a site like this because we have no control over what those reviews say, but we do prefer transparency. So about 2 years ago, we asked them to list our product on here. And as you can see, Jigsaw is currently the #1 rated company on Investimonials. So what is it exactly that we do? Well, Jigsaw, we're primarily a software company, so we're not an educational company. Or rather, we make our money from selling software, and we do have a library of educational material available free of charge. Some of that's just to customers, but most of it is available publicly. Now, that educational material exists so that people understand both order flow theory and how to apply order flow practically in real time. And we could make some claim that we give this information away because we're so charitable, but as a small company, it really saves us a lot of time in answering beginner level questions from people new to order flow. So our customers can get educated and then contact us when they have questions that come up at execution time. Now, that doesn't mean to say the education material is beginner level either, because if that was the case, Guy wouldn't have us on here. So the educational material we've got is actually in use right now by prop shops in UK and Australia as part of their intern programs, and partly that's because the material's good, and partly that's because their educators are a bit lazy, and if they can, take the weight off, they will do. Now, as you can see from some of the comments here, we do believe very much in understanding our customers by engaging with them, and that's customers both on the retail and the professional side of trading. And we also encourage our customers to talk to each other, and we give them a chat room and a forum on which to do that. And that in turn helps us keep close to what our customers want and need, and helps us to improve the product. And we learn as much from discussions with other traders as they do from us, and in fact probably more. So in short, what we are is a customer-focused software company with an educational component, a free educational component that actively engages with our customers and encourages them to engage with each other. And we do try to keep things as transparent as possible. So if you like what you hear today, you can go and check out independent reviews. You don't have to believe us. Now, before we look at the benefits of order flow, #1 question that most people have when they first hear about order flow is, does it suit the way I trade? So let me give you a rundown of who, in my experience, is using order flow. Okay, and that's based on our own user base. Now, in terms of trade styles, we have about 20% scalpers, and the scalpers are people who generally trade without charts, and they trade very frequently throughout the day for small targets with very small stops. And just to give you an example, we do have one customer whose average time in trade is less than 10 seconds, and he's got a win rate of over 80%. And you think, wow, win rate of 80%, that's just magical. It just must be a miraculous way to trade. But what he has is a win rate of over 80%, and he needs that win rate because basically he has very high commissions as a proportion of his profits. So it's not a miraculous way to trade because of the win rate. It's just, it wouldn't work. You wouldn't be able to pay your commissions if you didn't have such a high win rate. And many of the scalpers are prop traders or ex-prop traders working from home, and they generally have much lower commissions because of their volume. Certainly the prop traders have low commissions because they're trading from the house. Now, in terms of profit potential or the learning curve, I've not really seen any evidence that scalping and longer term day trading are any different really in either the amount of time, the amount of profit you can take, or really over time, how rewarding trading is. But scalping does have an edge in terms of giving you the most trading experience in the shortest time when you're a beginner. So it gives you the most time managing trades because basically you're doing more trades per day. So typically a longer term day trader is going to be taking 1 to 4 trades a day. Now the fact is that most trading education material is focused on technical analysis of some form and longer term day trading, and that's why we see fewer scalpers as customers at Jigsaw. Now there are some niche educators teaching scalping, but most traders stay away from it as they're not exposed to it and they don't really understand what it is. So the large percentage of our customers are just longer term day traders, and that includes myself, and that's people looking to stay in positions and take a larger proportion of the daily range, often staying in trade for hours. And they use order flow to refine their entries or reject trades when they see order flows against them. And that's what I do myself most of the time. But I let market conditions dictate what style to use, because if it's a low volume, small range day, then scalping small targets is a good way to make your daily target and then finish the day earlier on. Otherwise, you often get into positions and just see it chop around your entry point for 30 or 40 minutes waiting for it to break. And that's commonly the case in the summertime and usually this time of year when the market slows down. So we might see the market change gears over the next couple of weeks as we go into Christmas. We certainly should. It would be normal. And when that happens, the experienced traders are going to change style. And the other thing is changing from scalping to day trading, or as a longer term day trader, introducing scalping is just part of the development process. So however you start, it's just one point of the journey. So if you're a scalper, it doesn't mean you can't start to look for longer term targets. And if you're trading longer term targets, it doesn't mean you can't learn scalping. Now in terms of markets, the majority of our customers are trading future markets, and mostly that's because of the leverage, but also because they're the most transparent. So there's no dark pools in futures. Everyone has to trade in the same location on the same exchange, and it's really a much more level playing ground. And it also means a lot of the games played by HFTs on some of the more disjointed or disparate markets, they're simply not being played on the futures markets. Now we do have stock traders, and they tend to stick to NASDAQ for various reasons, and stocks with decent volume, which is like 500,000 shares or more a day. Now that decent volume doesn't apply to futures. You can trade DAX with 100,000 contracts a day. When it comes to NASDAQ shares, you really need higher volume and lower spread. So sticking, below $80 per share, because there the spreads are narrower, and that does make it easier to read. Now the thing about NASDAQ, it is not an exchange. It is a collection of exchanges or a collection of servers in different locations. And in some cases, these servers are actually intentionally kept far away from each other to encourage HFT participation. Okay, so if your HFT can be the shortest route between two servers, they can take advantage of a small price discrepancy that nobody else can. Okay, and that's one of the, it's called latency arbitrage. And we also have dark pools of liquidity, which is like a little bit like going fishing, where you just kind of have to fish to see if there's the other side to trade with. And the dark pools exist because theoretically it's more fair. Nobody can see the liquidity, so nobody can front run you. But the reality is nobody can see the liquidity in the dark pool except the prop traders of the firm that owns the dark pool. So basically, it's not a terribly unfair market. HFTs aren't going to stop me making money day trading stocks, but it is a less fair market than futures. Now, a smaller proportion of our customers are trading Forex. Now, as many of you know, there is no market depth. There is no time and sales for Forex, which means effectively there is no order flow for Forex. And it is the most jointed, spread out market there is, but it has a really low entry cost. You can trade really, really, really small size. I don't know if they still do, but Oanda used to do accounts where you could literally trade for pennies a pip. And what many traders do is they'll watch the order flow on the Forex futures, but then they'll trade the equivalent cash forex market. The benefit being they can trade very small size. They don't have to trade on sim. So they've actually got skin in the game, but they can trade very small size and start trading very low risk. So it's not a bad thing to do. Certainly, it's definitely a level up from sim trading where you just don't get that feel of being in a trade. Now, there is no arbitrage, and so there is no order flow for the cash forex, but arbitrage keeps the forex and futures in line. And many people say, well, yeah, but the cash forex market is so big, surely the futures market's always lagging. And of course, if that was the case, I mean, I would love that to be the case, because if that was the case, we'd all be able to sit back, watch the forex, and then make money on the lagging futures. But just like the S&P futures and with its underlying index and the related SPY ETF and the options on the stocks, there might be a clear leader for certain periods of the time, but there is never a clear leader all the time because of that role arbitrage plays, because there'll always be somebody step in and close the gap. And what we can see is that order flow comes into these related markets at the same time in human time frames. And if you worry about which is the tail and which is the dog, you'd basically never get into trade on any market. Now, roughly 30% of our customers are full-time traders, about 10% in a professional environment, including a few hedge funds. 20% are ex-prop traders or ex-floor traders now trading their own account at home. Mostly that number's bigger because basically the professional traders have less control over which trading platforms they use. But the majority of our customers are at-home retail traders with no professional experience, and most of them come to us with many years of experience. You know, I'll talk to people, you know, how long have you been trading? And they'll, well, you know, and they're kind of shy to answer the question. You know, how long have you been trading? Well, 10 years, but I've never made any profit. So got a lot of experience, but never made any money. And in many cases, they've already spent significant sums on trading education, but really no payoff, no benefit from them. So they have a good understanding of what doesn't work. They are very, very wary. They've been bitten many times. But they go through educational material, see it makes sense, and they can actually sign up for a risk-free trial. Now, a lot of the newer traders we don't get because they look at our site and they look at the products and think, well, that looks a bit difficult. You know, I'll find myself a red light, green light system to tell me how to trade nice and easily. And we usually catch those guys once they realize that sitting on your butt at home and pulling money out of the market might actually require a little bit of effort, as you guys know. Now, what I'd like to do is run through the main benefits of using the tools or using order flow. And we're not going to try and cover all of the benefits of order flow today, but rather cover the main points and the things that you should focus on first, the things with the most payoff, okay? Because, you know, order flow, it's a bit like price charts, right? There's a price chart's just a chart. Order flow is just a set of information. There are many ways you can use that information, and just because somebody does one thing with order flow does not mean you have to. So we'll look at the things that are going to give you the most benefit in the shortest time. So the first thing we'll look at is momentum. And this should really be a starting point, because if you can recognize when a market has momentum, you're going to stop trying to trade against it. And that's going to mean very quickly less losing trades. We'll look at bidders and offers absorbing buying and selling and how they try to hide when they're doing that. They try to cover their tracks and how we can clearly see that they're trying to hide. We'll look at the pace of the market, how it flows up and down, and the apparent ease with which it does that and what that means in short-term direction. And that's kind of a touchy kind of feel concept, but we can tell you how to get to the point where you can actually feel those things for yourself. We're going to look at how order flow can be used to manage your trades, especially in the early parts of a trade, to give you a more rational way to decide whether to stay in a trade other than, oh, my stop got hit. And then finally, we're going to look at the learning curve, how quickly you can expect to see results from adopting order flow and the best approach to take to learn the skills quickly. Now, it's probably not going to come as a great shock to discover that the most important aspect of order flow is the flow of orders and their impact on price. And what we pay attention to for momentum is what is trading right here and right now, and that's what helps you to confirm and reject and refine your trades. And in fact, that's really the key to kind of all order flow techniques. Now, what we have here, we have the Jigsaw tool. So let me just explain first. Jigsaw is a plugin to a few trading platforms. It's a plugin to NinjaTrader. It's a plugin to multicharts.net, multicharts.net special edition. It's a plugin to a platform called OEC Trader, which a lot of brokers rebrand. So if you go to Daniel's Trading, it's DT Pro. If you go to Global Futures, it's GZT Trader. If you go to Stage 5, it's S5 Trader. So there's a lot of different brokerages that support this platform. So the charts are from the platform. Everything else you see is from Jigsaw. Okay, so in Jigsaw, in the red box here, we have something called the current trades. So what we're seeing there is sell market orders that sold to bidders on the left and buy market orders that bought from offers on the right in blue. Okay. Over on the top left here, we have something called the summary tape. And that's showing buyers on the left side here, buyers on the right side here, and sellers on the left side. And what it does basically, it prints a new line for each new price that trades. Over on the right hand side, we have something called power meters. And all that's doing really, it kind of sounds a fancy name, but all it is, it's showing sell market orders in red and buy market orders in blue. And it's basically a way to see, a way to get a glance at the balance of trade. So the balance of trade is important. And we have different ways to see that. So in this case, this one is looking at all trades for the session. And we've got an R button there that lets you reset that at any time. Down at the bottom here, we have another couple of meters. The top one is showing trades in the past 60 seconds. And the one below it is showing trades in the past 3 minutes. And you can set those time periods yourself. And what it's doing, it's not resetting every 3 minutes. It's actually showing a trailing 3 minutes. And it's just purely the 3 minutes. It's for no other reason except that's what I like to be able to see. When I'm trying to judge if the market's turning around, I'm expecting those meters to turn with the market. Over on the right, we have something called reconstructed tape, which is showing you large trades executed in the past 3 minutes. Again, 3 minutes is my preference. Here I'm showing trades above 50 contracts. And the reason I set 3 minutes is because I don't want to watch this all the time. Some people, tape readers, they love to watch this all the time. I like to just be able to look across at this, glance across, and see just recent history. And it's when I look across at this, I know I'm just looking at what's happened in the past 3 minutes. I know I'm not looking at something that's stale 10, 20 minutes ago. There's a lot of things to look at, and I'm not suggesting that you watch all of these things. And each tool will resonate with different people. And like I say, order flow is not a technique. It's a set of information. We're going to look at techniques to use that information, but it is just a set of information. And all order flow tools basically try and put that information into a more accessible, more readable format, and Jigsaw is no different. So we give you the choice to mix and match the tools, but what we do advise is that when you get started with this, you actually follow our instructions and just focus on one specific thing, one specific part of the tools. And the reason is that's the fastest way to get started with order flow. Okay, so follow our instructions to the learning curve if you decide to take a try with this before you start changing what you see on the screen. Okay. Now, reading order flow is mostly about the pace of moves up and down, how much size is trading on the buy side and the sell side, and importantly, what is the reaction to that buying and selling? Okay, so for guys that are longer term day traders like myself, the way I like to put it is whenever you get into a trade, you get into a trade because you expect other traders to do something after you enter. So if you buy a market, you go long, you're expecting other people to buy afterwards. You're expecting traders to behave a certain way after you enter. And what order flow is showing you is that behavior. It's showing you the change in behavior. Okay, so you're looking, we know we're all trading because we expect traders to behave a certain way. Order flow is showing you if the trader behavior really is changing. Now in this slide, what we can see is a market with no clear direction. Okay, and how do we know that? Well, first of all, if we look on the meter over here, we've got 10,700 sells, 9,400 buyers. That's not an imbalance. That's not, sure, there's more sellers than buyers. That's not a serious imbalance. Okay, so by imbalance of trade, you're usually looking when a market turns around, especially the S&P 500, you're looking at 1.5 to 2 times. If it turns down, you're looking for sellers to outnumber the buyers 1.5 to 2 times. So this kind of imbalance is irrelevant. if you look on the current trades here, there's no obvious imbalance. There's no one side that really has more volume. Sure, I've got a 500 here on the buy side, but if you look, really, I've traded up and down since this session started with no clear view of which side's got the upper hand in terms of volume. And over on the tape here, I can see large trades on the buy side and the sell side. Again, there's no dominant side. And like I said, one of the first and easiest things to look for in the order flow is momentum. And right now there isn't any. And there's a few reasons that momentum is important. So the first and most important is if you can't recognize clear momentum, you're going to keep ending up trading against it. And now momentum isn't something you're necessarily going to see on a price chart, not until the move's well underway or over. So if you enter a trade long, but there's overwhelming momentum in the order flow to the downside, you will absolutely immediately be offside in that trade. So you'll immediately go into a losing position. Now, secondly, you want to know when momentum is on your side. So once you're in a trade, you can actually relax a little bit once the momentum of a move has occurred in your favor. But you should exercise caution if the market is still balanced and has not shown clear momentum either way, or if it's moving against you after your entry with momentum. Now, you can also join momentum moves, and this is something that kind of depends on the state of the market. So if the market is running sluggishly or a little bit slow overall, it's not a good idea. If you've got a thinner market like crude futures or DAX futures, or you're generally in a more volatile period, then those momentum moves can be sustained over a large range of prices. And you can actually join those momentum moves, and that's one of the things that scalpers do. So what does a momentum move look like? So first of all, if we take a look at this slide, we can see we've got 500 sell market orders that have sold into 1983.25. Okay, so overall, we don't have clear momentum, but right now we're seeing a little bit more trade than usual here, which means effectively buyers are starting to absorb some of this selling. And what we're going to see that once that level breaks, once the buyers give up on that level, is we actually see the market start to move down aggressively. So as that aggressive move starts, you can start to see imbalance. So you can start to see on the current trades, you can start to see it's weighted to the sell side. So let's just have a look at what we can see on the screen. So first of all, if you look at the meter up here, the meter's actually been reset. So when I saw the 500 contracts, I reset the meter. You can see 2,800 versus 1,600 sells to buys. On the short-term meter, you can see over double the sellers to buyers. On the longer-term meter, it hasn't quite caught up yet. This move took 13 seconds. Okay. We can also see the reconstructed tape here is overwhelmingly red. And if you look in the top left also, you can see, again, overwhelmingly, we've got trades to the sell side. Now, as well as the size, we can also see the pace of the market. Now, you can't see that in a slide, obviously, because it's not live and it's not moving. But we moved down from 83.25 to 81.50 in 13 seconds. That's very apparent in real time. And we can see also at the time, it takes very few ticks back. The market just doesn't tick back in that momentum move down. Now, before I move on and look at the positive momentum, what I'd like to do is just look at one other aspect, one different perspective. Because one of the things that we can also see is bidders are getting out of the way. And we can see offers adding contracts. Now, at this point, a lot of people say, I don't know what a bid and an offer is, which is fair enough because a lot of people new to trading that have been focused on price charts don't know what bids and offers are. So bids and offers are just limit orders on the buy side and the sell side. So this is the buy side here, the inside blue column, and this is the sell side. So they're basically waiting for a market order to come and trade at their price. And sometimes that represents real demand and supply. And sometimes, a lot of the time, it's just people putting in orders to make the market look strong or weak. And a lot of this is algorithmic trading. A lot of these guys are market makers. Now, these outer blue columns here and the outer red column here is something we call the snapshot. And that shows how many contracts have been added or taken from the limit orders here. Now on the way down here, market makers, algorithms, and anybody with any common sense is getting out of the way on the bid side or the buy side. Okay? On the other hand, they are adding contracts to the sell side. Okay? And why not? So if we look here, we can see 157 contracts, 47, 37, 10 contracts being pulled. Over on the sell side, they're adding 215, 57, 6 contracts. And why not? Because momentum is to the downside. So the market makers, algorithms, that they have algorithms that tell them there's something called toxic order flow, which is a fancy term for there's a lot of buying, a lot of selling coming in. So when they see signs that selling is coming, they'll just pull out of the way. But they're going to add on the other side, because basically with momentum clearly to the downside, if you can get filled at the offer on a sell order, you have a really good chance of getting into profit very quickly. Basically benefiting from somebody making a bet against momentum. And we can see this behavior here on the snapshot column, but we can also show it over here on this meter here, which is basically called the snapshot meter, which is basically red is basically for anybody that pulls a bid goes to the red side, anybody adds to the offer goes to the sell side as well. Okay, so anybody that adds to the bid goes onto the buy side, and anybody that pulls from the offer goes onto the sell side. So that's just showing an overwhelming bearishness there. Now, as we move on, what is very typical when you see momentum moves, and there's a whole psychology with trading of people wanting to always play a reversal, okay? Because what we can see here is we've now got into a position where we've got two-sided trade, okay? We've got 648 sell orders, 656 buys, and we can see also that more contracts than usual are trading this level. So even though we can't see this live, and even though it's not video, we can't see it's not moving pictures, we know that we've spent more time there, okay? Because we've traded more there. And these pauses, this momentum, sorry, this pause, this extra time doesn't mean that momentum has died, and it doesn't mean a reversal is imminent. The market is often going to take a breather, and it's dangerous to trade against a move just because it pauses like this. In fact, this pause is giving you a chance to re-enter the market, sometimes after the pause and sometimes after a little retrace. But you do have to be fairly nimble, because when you get these pauses, the market often continues again swiftly and puts in another momentum move after that pause. And here we see the break after the pause. Now, I meet a lot of losing traders, and the common element with most of the losing traders I meet is they built their strategy around trying to buy the low of the day or sell the high of the day, and each time the market stalls in a move down, they think it's the bottom and they buy it. But in reality, what they're doing is consistently trading against the intraday trend. And many of the customers I've met, and many of the people that have adopted order flow, have made huge improvements to their trading just by getting out of that habit of getting on the right side of momentum and not fighting it. And that's why momentum is the place to start. Now, the next thing we're going to look at is icebergs and absorption. And this is where the bids and the offers step up and absorb selling. So the bid side, the buy side absorbs selling, or the offer side absorbs buying. Now, an iceberg order also involves this thing called absorption. But it's when the bidder or the offer side try to hide their real intention and slowly add more limit orders as market orders trade into their level. And one of the interesting things about this sort of activity is there's a number of ways you can see it, and most of them don't involve looking at the bids and offers at all. It really is enough to just watch the orders and their impact on price. So let's just quick run through the different components that we're looking at here that can help identify this behavior. And once again, I'm not suggesting you try and use all of these things, but let's quickly run through them again. Okay, at the top left here, we have this thing called the summary tape. Time is on the far left. The delta, which is market buy orders minus market sell orders, on the right. Then we have the best bid price here, which is basically something known as the inside bid, and the best offer price here. And then we have the total amount of sell market orders that have traded at a price, and the total amount of buy market orders. and the sell market orders sold to the bid and the buy market orders bought from the offers. Just kind of get used to that concept. Now down here we said we had power meters. The one on the bottom showing you trades in the last 3 minutes, the one in the middle showing you trades for the last 60 seconds. And the meter on the right is just showing you all the orders, buy market orders in blue, sell market orders in red, and again showing you all activity for the session or since you last did a reset. And then below that we have something called the reconstructed tape, and again showing trades of 50 contracts or more and just for the past 3 minutes. Okay, now over on here we have the depth and sales. The left side blue background column shows me how much has been added or taken from the bids. The inner blue background column show me how much is currently bid, and the grey background column with the red numbers show me how much selling has sold to those bidders. So let's see what an iceberg looks like. So what we can see here, if we look at the summary tape, we can see it's 78.50, 1,598 contracts traded at the sell side, but price hasn't moved down. And that basically is a lot of selling, and the sellers have got nothing for it. We can see the meters are all showing overwhelming selling, but again, that's not been reflected in any move down. And earlier I said the important thing you watch about order flow is you're watching the buying and selling and the impact on price. Now the tape shows we've got a lot of large sellers that have sold into 78.50, but the result has not been any move down. So those sellers are trapped. Now we're right at the top here, we can see that somebody sold over 400 contracts, and down here there's another trade for over 300. So the other thing we can see, the chart shows a little green or a little blue triangle to show us that an iceberg order has been detected. And we can also hear an audio alert when that happens, but I kind of see that as more like trainer wheels for somebody new to order flow, because really it's this information here that is the richest information. And if you're watching this, it's very, very difficult to miss once you get used to reading it. So what we can see the 1,598 contracts that sold into the bid. We can see that the offers though, the bids, sorry, we're only showing 238 contracts bid. Okay, so we don't see that the bidders are actually willing to trade a lot of contracts, but they obviously are because of the amount of trade that's come through. And then over on the left, the snapshot tells us that actually 1,252 contracts have been added whilst we've been trading at this level. So it's pretty obvious from this that bidders are adding orders to their bids as people sell into them. And that is just a very typical move. And, you know, basically when you see a big bid and you understand iceberg, and these iceberg orders are actually supported by the exchange or many of the exchanges. So you can actually submit an order saying, I want to buy 2,000 but only show 200. Okay, very, very easy to do. And if you think about it, there's no real reason to show your hand. If you want to buy 2,000 contracts and you put a bid out there for 2,000 contracts, people are going to jump in front of you. So that's the reason we have these icebergs. And here is where we ended up. We can see that we had a quick pop-up. We had a very quick pop-up here. We got a lot of trading on one side. And that's indicative of traders being stopped out, a stop run. And that is also something that once you start using order flow, you're going to be able to see when you move from an area that people have been stopped out or that people haven't been stopped out by the pace, by the size of trades. Look, if you look over here on the tape, we can see 300s here, 400s here on the way out. Basically, these are guys that are bailing out. They're buying, they're covering their shorts. We don't know exactly which order is an exit order, but we can make some presumptions based on the fact we were trading around this area for a while, built some volume, then moved out the top of volume, and we saw a flood of buy orders. That's what a stop run looks like. So it's possibly the same people that were trying on the last slide to push the market down, thinking it was reversing. Now what we can also see is we've got a little blue X on the chart, which is a marker for a delta divergence, which tells us basically that sellers were dominant but price moved up. Now let's look at another iceberg. In this second case, we've got this YH in the leftmost column, and that indicates we're at yesterday's high, and that's not automatic. That's just literally a column where you can type anything in. And so I put YH in for yesterday's high, which, you know, if you trade the E-mini S&P 500, you'll know it's a very common reversal point. Now we can see that as we move through that price, you know, we got some acceleration. You know, we got the stops. We see large buyers buying from 81.50 through to 82. And then at the top here, we get a total of 1,170 contracts, 8150. We get a total of 1,170 contracts, and then we move to the upside. So we break to the upside, and then we get another 1,700 contracts trade at 1982. And then as we move up, we can see the buyers keep buying. So we still get some buy orders, not as many as we had previously, but we can see a total, not as many on the large side, but we see a total of 2,000 contracts traded, bought at 1982. And this is a case where the order flow event occurred over a series of prices. So you'll often see absorption. You'll see the buying getting absorbed at one price, and they'll move on a few ticks, and for there to be absorption at one of the next prices. And this is a typical, I'd call it a game, okay? Because what you'll often see, there's a lot of games being played. If you imagine being a buyer and that you bought 8150 and you saw the absorption there, you'd probably feel a little bit wary. But then when it broke through, you think, great, my side's won, and you might buy some more. But in fact, the offers just pulled out of the way there and put in some offers higher up, waiting to catch those buyers out that thought they'd won. So if you watch this often enough, you'll begin to see that there are some games being played in these areas. And what we can see, as we move on, just give that slide a chance to build. What we see is as we move on, eventually sellers come in and start pushing the market down. Okay, they start trading to the short side. Now we all know there are no sellers and buyers in the market. We all are trying to trade. We're all trying to trade to make profit, right? None of us come into the market and say, I'm only buying or I'm only selling. So the sellers could just be people that bought earlier on. They might have bought the last iceberg, selling this iceberg. But very likely, the people that were doing this absorption, the people that bought all these contracts up here, are most likely the people that started to put in the larger sell market orders. So deciding to hit the market with market sell orders to push it down and really get those people who bought at the top and at 8150 and get those guys to stop out. Now in terms of a trade entry, there is no reason to trade the iceberg itself, especially on a full reversal trade. So this is a market that's been moving up. I've already said there's a lot of people who are always fading the market, so this isn't the best place to take to trade an iceberg. On the other hand, down here where we can see the buy iceberg, that's with momentum. This is against momentum. So there's no need to trade the iceberg itself. You can wait for the additional confirmation of the push down where you know that the sellers above are trapped. Now you can get in when those guys start to exit. So order flow is about reading the market. You still have the flexibility to get in with as much or as little confirmation as you like. And this is where we ended up. And that brings us to the next iceberg. So in this case, we see the iceberg on the bid side here at 76.50. Now remember that price. Remember 76.50. Because what is interesting here is the follow through. Because these markets, especially S&P, they often give us a second chance to enter. And if you've been trading the S&P and a lot of other markets, you'll have seen many times you get into a trade, you go offside, so the market moves against you, it comes back to your entry price, then moves against you, comes back to your entry price, moves against you. It's almost teasing you, asking you to get out of your trade, okay? But that's just the way the market moves, and these markets give you a second chance to enter. It's not just to exit. And after the iceberg order is executed, we can see it comes back to the area a number of times, but just doesn't want to trade below it. So we can see here at 76.25, we just trade 9 contracts, okay? Then we move up, we moved up to, I've gone forward a few slides, but just let me explain what happened basically. We went back to 76.50 and we basically just traded a handful of contracts, moved up again, moved back to 76.50, just traded a few more contracts, eventually traded down to 76.25. And what you're seeing basically is the iceberg became a sort of hidden support level. Okay, so what you'll see the iceberg trade and you'll see price move away, come back, test it. But when it comes back, it doesn't test that level with a lot of contracts. You can see the last time we did the test, we only traded 21 contracts in 76.50 and 9 contracts in 76.25. Okay, and that's one of the things we're going to talk about next, is kind of like when traders just don't want to sell into a level. Okay, so but there's no reason that you would have been looking at 76.50 if it wasn't for the iceberg, because 76.50 wouldn't be any more relevant on the way down. Sure, it's relevant now, we can see it moved off, but it wouldn't have been any more relevant on the way down from a charting perspective. And again, what we saw the iceberg, then we saw people come into it, and we saw very, very few contracts trade as we retested that area, and then eventually the large buyers come in. Now again, you could wait for this buying before you go long. You'd have more confirmation, but that would come at a poorer entry price, and there's nothing at all wrong with that. It's an acceptable payoff, and it really comes down to how risk averse you are, whether you trade the iceberg or you wait for a buyer response. Now let's have a look at something which is more, I don't know, touchy-feely, okay? This is more about the feel of the market. And again, it follows on from what we just looked at, is the market seems to move up and move down easier one way than the other. And how you can use that to confirm a trade, because I'll tell you that the icebergs are very easy to see, okay? But this is maybe takes a little bit longer to catch, but it is actually a better signal. And one of the reasons it's a better signal is because less other people can see it, or less other people appreciate it. So in this example, the market has moved up and we're in a small range. So we can see on the chart here, we can see, we've moved sideways after the move up. We can also see on the volume profile here, showing just volume at price, that we've got this area of higher traded volume. So we've just been rotating around the area here. We can also see the offers above here are quite big. I mean, if you look at the offers anywhere else, 617, 1400, 800, that's much bigger than we've seen everywhere else right now. And everything, when you look at order flow, is really, everything's relative, right? So when you're looking at large, you don't send me an email and say, Pete, what is large? What constitutes a large size bid or offer, on such a market? It's just basically, well, look at it. If it's bigger than everything else, it's large, right? And you got to remember that people put these large offers, large sell limit orders out here. They put them there so that you can see them, right? That's not accidental that they're there, okay? And it doesn't mean that the market's going to reverse, okay? So somebody's putting that there so you can see it. So if it's not obviously large, it isn't large. So if somebody wants to make the market look weak, as in this case, right, they're not going to, if you've got an average depth of 400, they're not going to put 401 because it won't be noticeable. They're going to put 800, 600, okay? But this means absolutely nothing at a level of support and resistance. And this is a level of resistance because those bids are where the double top is, right? And it means nothing other than confirms that lots of other trades are looking at this level. So that doesn't in any way guarantee the market will hold and reverse. Okay. Also doesn't guarantee the market's going to move through. It's just a bit of information that helps you confirm your analysis is good. So if you're constantly looking at price levels in the market where the bids and offers are completely neutral around those price levels, then it's just you and a couple of other guys that are looking at those levels, and the market's not going to reverse there because you need participation for that reversal. Now remember, we've seen two-sided trading here. Remember what we've seen in these middle columns is what's trading at the bid, the sell market orders in red, and what's trading at the offer, the buy market orders in blue, just this time round. Every time we get to a new price level, it'll clear. If we spent more than 2.5 seconds out of a price, it'll clear when we go back. Now what we can see that at this point, 1,090 contracts trading into the offer. And, like I say, everything's relative. So we can see that that is exceptional size relative to what else is traded here. And we can also, see on the buy side, we've actually got large buyers all the way up to 79. So at the top of the range, we see sellers that have absorbed the buying. We see large buyers trapped. So at this point, you do have a potential short trade on. But you are fading overall momentum. But we could sell 78.75 here, betting that the top of the range is holding and benefiting from these longs that have got here getting stopped out. If we trade up to 79.50, basically your premise for the trade is wrong. So if you're leaning, basically, we call it leaning, you look at these orders here, you say somebody's taken on those orders, the guys are stuck there. So if I take a short to 78.75, if it trades to 79.50, you're wrong, basically. Your trade's over. Your downside, you've got good downside on that trade. It's a very, very good risk-reward trade. okay, if you get out of the way. And one of the problems with getting out of the way of a trade like this is if we do pop up, the shorts that were short from here will exit fairly quickly. So you have to be pretty quick if you're going to take this trade. So it is a little bit risky trade, but you know, the reality is you don't need to risk a lot of ticks on a trade like this. Okay. Now, overall momentum is to the upside. So for me, I don't take trades like this because overall momentum is to the upside. So I think the better trade is to actually see if it comes back and see if we can get the buyers stopped out. Okay. Because we've got momentum on our side, and then see if we can get a good price. So what constitutes a good price? Well, if you look at these trading ranges are going to keep forming. So if you've never looked at this, a volume profile, you should watch a trend day and just look at the volume profile. And what you're going to see, it's going to move, it's going to build volume, it's going to push, build volume, it's going to push, it build volume. All the time it does that over and over again. And it's a real revelation the first time you see it. And what it does when it builds volume, it just rotate around here a little while, and then it will poke, very often, more often than not actually, it will go to the upside. And, the sellers that were short from that area, because these are all buy and sells. So basically you go upside and the sellers get stopped out, and that gives you a little push up, and then you rotate somewhere else. So it move, rotate, move, rotate. And the reversal usually happens when this area fails to the downside. So your good price to get in on a long trade here is actually the step in the volume profile. And by the step, it's a visual thing. You can see the histogram here. I've got 9,000 contracts traded here, 5,300 below. So that's a step, because you can see a step basically. So good entry price would be 1978. You might not get a fill there, so you could step ahead 78.25 if you see that the order flow is confirming your trade. So what we're seeing is you've got a little drop. There's no sign of the sellers getting stopped out. Just a small pop down. If you'd been short from 78.75, you'd be quite happy. We're now at the bottom of the range. And what I've done now, I've actually reset the meter here to make it easier to see any new selling pressure that comes into the market. Okay, so what do we see? Market ticks down. We get 6 contracts traded. And after that 6 contracts trade, did you get to see that? After the 6 contracts trade, it ticks up again, okay? And what you're going to see is that's really common, okay? It'll tick down, stay there for a second, and then tick back up and trade 30, 40 seconds. Tick down again, it'll stay there for a second, tick back up, trade 30, 40 seconds. You'll also notice on the ticks down, really won't be able to trade any size. So you'll see this, and it's like it's more of a feel thing, but you can see every time you come back to a level, somebody buys it and it ticks back up, okay? The price moves back up. And that is almost certainly somebody that has standing orders to keep buying that market every time it ticks down. And that's certainly some sort of algorithm. But as you can see, when you watch this in real time, it doesn't occur at the speed of light. It's like down a second, up 45 seconds. Down a second, can't stay there, up 45 seconds. You see this and you do have time to react to it. And again, just because you got the signal doesn't mean you have to take the trade. You can wait for the buyers to come in. But if you watch this activity a few times, you'll get a feel for what it means by the market can't hold ticks down, or it seems to be ticking up easier than it is ticking down. Now we do eventually end up moving through 78, and we see that same lack of interest here at 77.75. Now don't expect these order flow events to all just occur at a single price. If the market is more volatile, these events will occur over a series of prices. So, when you see this kind of signal, still give it a little bit of time. Still give it a little bit of room for your trade. If we look at the sellers on the recon tape, we've got big sellers from 78.25 all the way down to 78 that aren't getting anywhere. So we have some size trapped at the bottom of a small range, just after a double top, where we know there's going to be a lot of retail reversal traders that will have come in and sold this market purely because it was a double top. And that's what makes this such a nice little trade. And it only makes a good trade because you have context, right? The context is basically you had your double top, okay? You came back down to a step in the profile. That's trade location. That's context. And then you had that order flow confirming it, where at the bottom of that range, you get to the bottom range, nobody's selling anymore. Nobody wants to sell into that area, Okay, sellers aren't there, and every time we tick down, somebody buys us and knocks it back up. Now, you're not the only person that can see that, and we can see here this is the result. You're not the only person that can see that. The other guys that are playing this market also see that. So what can we see? We can see we've had a move up. We're starting to see evidence that we've got a stop run. We've got these buyers here, and you know, the offers above, they've gone. Okay, we can see actually some of them were real because we traded 1,400 contracts here, but the offers gone. They were just, you know, mostly they were just there to make the market look weak. So a lot of this activity on the way up is because of these perma faders, traders that always look to sell any move up or buy any move down. And you could have sold the top of the range at 1979. You know, you could have sold here and you could have made 4 ticks. But the real play was to look for weakness on behalf of the sellers or those sellers trapped, partly because momentum overall is to the upside, and partly because those seller stops will help you move up. And in fact, to be honest, it doesn't really matter which trade you take, because if you buy 78, you're going to benefit from sell stops, and you don't need a huge stop. If you just sold 78, 75, if the trade had worked, you would have benefited from the buyer stopping it. And again, you didn't need a huge stop. So it's really a matter of saying, okay, which side of the market am I going to go on? Get myself a good price, get the order flow confirmation. Sure, if you'd have taken the 78.75 trade, you would have got 4 ticks. You wouldn't have got a fill if you tried to exit 77.75. It would have come back at you. You would have had time to get out of the way. You would have been fine. You wouldn't have made any money, but you would have been fine. And sometimes, you know, it is a bit of a coin toss. Sometimes you don't really know, you know, which way it's going to break out one of these areas. Like I prefer to take the continuation trade. But it doesn't really matter. It doesn't really matter. If you take the short, you still had a good location and you still had, you know, the market move your way a little bit and you still had time to get out of the way. Okay. So you had a good trade location in terms of the bottom of the range, and we had order flow telling us nobody's interested in selling below. That's a good place to get in. Now let's look at trade management. Okay. And the reason we're going to look at trade management is because it's one of the easiest things to learn with order flow, and it's one of the things that's kind of got the fastest payoff. Now in this image we can see we're actually close to the opening price. The opening was about 1983, just above the opening price. After a few days of relatively low volume, so you know you can't see that here, but I'm just telling you, you know, up to this it was relatively low volume, so we're expecting kind of low participation anyway, and we've just popped out of this higher volume area we can see here. And what we can see as we pop out, we can see the buyers really struggling to get any headway. We can see the first sign of absorption with this 666 contracts here. There's no evidence of a stop run as we've broken at the top. So this could be a false breakout. Now before we go into look at the trade, we can see, you know, on here, you know, the current trades, the center columns, show us some recent trade history. And we also have the strength meters that show us some recent trade history. And for trade management, you really want to kind of not see any of that stuff. You're not really interested in history when you're managing a trade. So what happens is we enter a sim trade. This is just a sim trade. I've done a couple of sim trades here that show specific things that you're going to be looking for. The current trade's clear, so all this information is cleared here, and the meter is reset. And this is done to make it easy to identify the order flow since you got filled. And also the DOM recenters as well. So you've got this big black line, the center line, so you can see how far, very easy to eyeball how far the price has moved. Now all traders obviously can see when price moves against them, but people using order flow can distinguish between price moving their way and order flow moving their way. So if price moves against you but supporting order flow is weak, there's no need to close your trade. If price moves against you and order flow is strong, there's also no need to wait for your stock to be hit, as your trade will most likely be a loser. Now as we move on, so far we can see order flow is neutral. We've seen the market trade a couple of ticks against us, but not with overwhelming buying. Now with all reversal trades, as we've said, you can wait for the momentum or you can wait for the other side to come in before you enter. And that generally means you're going to be getting in at a slightly poorer price, but that's just the price for additional confirmation. Otherwise, even if you're seeing like the buyers fade away at the top or the sellers absorb at the top, you still need for the market to really roll over and for sellers to become dominant. And there is a little bit of a pause that you'll see. You know, when the buyers are buying and the market's moving up, sellers don't jump in straight away. But when it pauses at the top and the buyers can't get through and you see the absorption, then the sellers can like, okay, these guys aren't getting anywhere. Then they start to push it down. And that pause also is that it helps the buyers to bail out because the buyers can see they're not getting anywhere. So on a reversal trade, you can't expect, even when using order flow, just because you see an absorption, it's not going to move straight down straight away. You still need the other side to step in. And that's what we're seeing now. We can see, if we look at the meter, it's showing sellers outnumber buyers by about 50%. We can see large sell orders coming in on the sell side, on the tape. And we can see sellers overwhelming the buyers, both on the current trades here, and if you look over on the left on the summary tape. And this is exactly what you want to see on your side when you're in a trade. And if you see this against you, this is when you need to consider cutting the trade. And you might even see the order flow coming against you like this when you're 3 or 4 ticks in profit. And you don't have to sit there and let it move through your entry price and let you stop get hit. So if you have order flow coming in against you like this, real momentum coming in against you, and prices starting to move against you, there's a really, really good chance your trade's going to fail. So you get out of the way. And I know a lot of people have trouble hitting the button, getting out of the way, but that's one of the biggest benefits of using order flow. Now let's look at another example. Now in this case, we put a resting limit order at the top of a high volume area where we expect to see a future imbalance between buyers and sellers. Now the reason you're going to have a future imbalance is effectively as you move up, if you get a stop run, as it kind of looks like a chance of it here, you know, not a very good chance to be honest. If you get a stop run, you've got sellers from this area that got burnt, and also people can see that the buyers are getting somewhere. So you've got happy buyers, you've got unhappy sellers. Basically as it comes back to the area, sellers just won't engage there. And basically, you can think about it as yourself. If you just sold an area and got stopped out and it goes back to the area, you're not just going to jump in short again there. It's just not a very natural thing to do. And it's kind of a silly thing to do. There's actually a video on our YouTube page called Day Trading Without Charts. Take a look at that video because that explains this whole concept of, you know, volume areas and when you pop out of a volume area, how it creates that imbalance. Very, very, very useful thing to have the volume profile. So once again, we can see the meter clears, current trades clear, DOM recenters, giving us a great view of order flow since we entered, which since we entered right now is neutral. Now what happens as we move on, we can see that, yeah, price moves against us a couple of ticks, okay, but there's no imbalance in the order flow. And as such, there's not really any power to that move down. And that doesn't mean you should let a trade move against you a huge amount. So you're still going to need a safety stop. But within reasonable limits, you can allow a trade with poor order flow move against you. Now, when looking at the order flow, the absolute numbers are important. So it's true that if you see 100 sell orders and 10 buy orders, you have 10 times as many sellers and buyers. But that amount of trade overall is insignificant, and that varies by market. So if you're trading crude oil futures, oh, absolutely, a few hundred contracts is significant. But if you're trading the S&P 500 futures, then you're looking for numbers in the thousands to be of any significance. So the ratio of buyers to sellers is important, but so is the total number of trades. And as we move on, we can see we still have balanced trade. So we still don't see any indication one way or another what's going to happen. But we have 11,000 contracts traded and we're still neutral. And at this point, the trade has become a bit more of a coin toss, right? One of the reasons is we didn't see the future imbalance because I wouldn't expect, if that future imbalance had paid off, I wouldn't expect us to see us trade at 1983. But the other thing is we've been sitting here for a while and there comes a point where you sit in a trade at your entry price for a certain amount of time. Your trades become a coin toss. There's no real reason here to exit the trade. But you also get to the point where there's no reason to stay in the trade. Now moving on once more, we can see we moved up. A lot of people are going to say, whoa, this is great. I'm excited. I'm confident. Price is moving up our way. And this is why I created this example. Order flow is still neutral, price has moved up. Now, for me, I don't see this any differently from the situation where the price has moved against me and order flow is neutral. So some people are going to get excited about this. To me, this is absolutely neutral. And in fact, I would probably exit a trade at this point because it's a slow day overall. We've actually got 6 ticks in profit. And as I said earlier, this is, after a few days of kind of pretty lackluster volatility. So at this point, you have to wonder how long could this situation continue? Because you've got a move that's got no supporting order flow. You don't have order flow on your side, but you're in profit, and it's worth considering, should you take those profits? Because this is the kind of situation that's probably not going to last. You've got no momentum. Okay. Now moving on again, we can see, indeed, price couldn't move up. It couldn't be sustained with that supporting order flow. And as we come back to the entry price, you can see I clear the meter here, so I can get just a view again of the balance of trade as it comes back to the entry price. And sometimes I just like to have a reset of this information just to see what's happening right here, right now, because right here, right now is the most important thing when you close your entry price. And as we move down, we can start to see some large sellers coming. And eventually, we see the imbalance to the downside. Now, obviously, we would not manage a trade like this. It's just an example trade to demonstrate some of the nuance of managing trades. It's not just about, is it on my side, is it not on my side? Is it just not there at all? Is momentum not there at all? So it highlights the importance of recognizing when a move has no real momentum. And the reason that's important is pretty simple. If the market tries and fails to move up, at some point, the opposite side is going to come in and push the market down just to test if they can push the market down and stop people out. And this is algorithms, but it's also people who are professional day traders who trade with size, and they're watching the order flow. Trading algorithms, HFTs, are almost 100% order flow. That's all they look at. And when they see this weakness in the order flow, or in this case, maybe a little bit, we've got this little bit of absorption at the top that, they might be looking at as well. They know there's a good probability that a push down is going to shake some of the long positions out. So managing your trades with order flow is actually fairly simple. It's one of the easiest skills to develop, and it's really something to focus on when the price is still quite close to your entry price. So for example, if you'd enter the market long on the S&P 500 futures and you're now, say, 4 points in profit, with order flow on your side, there would be no need to focus so intently on order flow. You just let the trade run. Okay? But what you're trying to do is babysit the trade until you see it's working and you are clear of your entry price. And that's as much as I'd like to cover today. I've got a few more points to make, but if you've got some questions, please type your questions in. Because basically these techniques that you've seen today are enough to make significant improvements in your trading. But the most common question I get asked is, how long is it going to take me to learn this? And that's a natural question to ask. And it's a question that most people avoid asking in this industry as well. So first of all, remember that this is a new skill for most people. So if you sit down and try to trade this, the first time you use it, you will not be successful. You will have problems, okay? On the other hand, don't believe what you read on internet forums about this 10,000 hours to learn how to trade. You see that repeated on many trading forums. That's over 4 years full-time work. Now, prop firms, and in fact also the old trading pits, wouldn't exist if that was the case. So prop firms, proprietary trading firms that basically take people on, fresh from college usually, sit them in a room, teach them how to trade, and then let them trade firms' money. They're teaching people usually in an internship about 12 weeks. And some of their students are trading live at the end of that 12 weeks. So it's a development program. It's not just 12 weeks in the classroom. It's 12 weeks of education, sim, education, sim. And this is what Guy Bauer used to do in the Australian prop firm. So 12 weeks, is what the institutional traders do. And, these institutions wouldn't exist. If you imagine being a pit trader and have to sit there for 4 years without making any money, or being a prop trader, the prop trader would starve and the prop firm wouldn't have any money. So our approach is to set aside time to focus purely on order flow, 1 or 2 times a day, 60 to 90 minutes at a time. And that's about as much as people can take focusing on something new. Generally speaking, okay, some people are exceptions. So if you find you don't lose focus after that 90 minutes, carry on, right? But if you need a break, take it, because I know some people get addicted to trading and they think they're doing themselves some benefit by staring at charts for 12 hours a day, but there's no benefit in torturing yourself. If you're learning to play tennis, you wouldn't start off with an 8-hour tennis lesson. So if you lose focus, just stop, come back later, and also relax, enjoy it. You know, don't kind of think I've got to force this into myself. Just relax, sit back, do the drills, and if you take that approach, you're going to be seeing patterns recur after 6 or 7 sessions. Now that's not going to make you an expert, but it's going to give you that aha moment that takes from understanding the theory you read about on a site personally, and then personally experiencing it and seeing it play out in real time. And within just a few weeks, you should be able to incorporate order flow into your trading to try to help you manage your trades. Now in addition, you should also be able to stay out of trades when momentum is clearly against you. Now the other thing I'd like to point out is there's some things on the Guy Bauer's Trading Courses site that also help you with order flow. So we have the Depth Traders Bootcamp. This is a big course. It's got all of the drills, all of the theory, all of the bits that prop traders will be told to do when they get into that prop firm. The DOM Starter Pack is just an introduction and a list of different setups that people use. Speed Trader is a set of timed order entry drills, again, just refining your skills. And then down here we've got some courses that Jigsaw has donated. Now, I have a standing offer to all Jigsaw customers, and that is to Google our New to Jigsaw Tools video and do 6 or 7 sessions focusing just on the things in that video. Then you can email me or Skype me, and we can have a one-on-one chat about what you're seeing and what that means. And there's no charge for that chat. Now, some people like to do this just to confirm their interpretation of what they're seeing. And for some people, they already know what they're seeing, but they just need a confidence boost and for someone to say, yeah, you're right. But one thing's for certain, once you learn to read and use order flow, you won't be able to trade without it again. Okay, so at that point, I'll go over to questions. As you can see, Guy's got an offer on right now on trading courses. There's a $150 cash back if you sign up in December, and there's a link. And Jigsaw, we've got a coupon code up until Christmas Day. There's always people that buy trading software on Christmas Day. I can't figure that out. Their mind should be elsewhere. But anyway, the offer's up till Christmas Day if you use it coupon code. I'd like to go over the questions now. I think not many questions, which means I either did a good job or you're all asleep. How do you spell Guy's last name? B-O-W-E-R. So it's Guy Bauer. I'll type that in to the chat. Guy Bauer. You can research Guy Bauer. He's written a few good books on options. He's a very, very experienced trader. Do we have any more questions? Thank you, Danny. Danny's saying very good as usual. That's a compliment. I always like to have a few compliments. Yeah, feel free to type in compliments as well as questions. Okay, I'll just give it a couple more minutes for the questions. If you've got no questions, you can log off. Okay, given the current volatility in the ES, I'm still getting away with 4 to 6 ticks, but I'm really, really selective in the trades I take. So again, I don't trade reversal trades. So the market is really, really volatile right now, but I'm still able to use fairly small ticks, but I'm really, really, really selective on the trades. So I'm, the way I see the reversal trades, I see that as like the heavy lifting in the market. So for a market to reverse, it takes a lot of change in behavior and it takes a lot of things to happen. And if you're, example, yesterday's low, there's a lot of people going to be looking to do stuff there. Once the market's already reversed, there'll be places on the way up where you can actually get in with fairly low risk, just looking for certain things. So I still prefer to wait for those things. I think I'm just like too old to try and take reversal trades. So even with the volatility right now, 4 to 6 ticks, I'm expecting the volatility to go down. This is rare for December to have volatility like this. Any other questions? Okay, yes, you can use the NinjaTrader free version. Okay, so Mike's asking if you can use the NinjaTrade free version and only pay $50 a month to Jigsaw to trade live. There is a version called NT Direct, NinjaTrader Direct, which is free to traders and you can trade through it. It doesn't have OCO orders and ATM strategies, but to be honest, you can get along without them. Yes, you can. There is a new version coming out soon. I've been promised that we'll have a visual depth history. I've seen it already. It looks really, really nice. We've been promised it'll be finished tomorrow, so I'm expecting it next Friday, but at the earliest. I've kind of beaten the programmer around. I've got a very, very sore programmer right now that's had to do a lot of work. So yeah, it should be next Friday. We'll go beta on the new version. That'll be available to all Jigsaw users. A lot of new functionality, no additional charge. Okay, I think we're done. Every time I say I think we're done on the questions, another one pops up. Right, we don't support Sierra Chart right now. But the other thing is, for Jigsaw, basically, it's a $400 license fee, and then you pay $50 to trade live. But we don't consider a Top Step Trader account live trading. Okay, so you can actually use a multi-chart, you can use Ninja Charts to trade a combine account. You won't have to pay the $50 a month. So Top Step account. Also, if you're using a CQG demo account, it will detect that. For the $150 discount, there's no coupon code. It's just literally if you sign up for trading courses in December, you will immediately get $150 back. And a guy's a good guy. He won't he won't renege on that. You can use Jigsaw with Market Replay. There's a couple of issues with Market Replay and Ninja. First of all, if you go back 10 minutes, everything refreshes. And the other thing is the replay data is stored at a kind of a strange granularity, a 1 second granularity. So what that means is it kind of pushes, pause, pushes, pause, pushes, pause, trades out. And it's not a very natural, way to kind of see the market. So I don't like using Market Replay. Tools work in Market Replay, but I don't like it. It doesn't move the same way as a live market. What a lot of people do is they use screen recordings of the live market and then go over that, because one of the things that does help, you can go over a whole day's trading in about an hour on the order flow, and basically you can actually go through it on fast forward, believe it or not, and still get a feel for where the market's been, what the order flow events were. So you can use Market Replay. I'm not a big fan of it. I prefer a screen recording. Okay, so any more? What's your ballpark for the current number of customers? Just over 2,500, Max. Okay, any other questions? Yes, we need to keep that number growing. We've got a lot of, as well as the depth history, we've got a really big release coming out in the first quarter. Support when installing, we got some customers in here. They will tell you the support's great. We've got, one of the things is with support. I got into trading because financial advisors lost all my money, and I was in software before that. One of the worst things I hate most about software support is if you've got two pieces of software running, the support people will always blame the other piece of software, and we try to avoid that. So, we've got a support email address. People can have my Skype ID. I've got a guy, Dave, who does most of the support. Anything really technical, I can get involved with. If somebody has trouble in installing, we can do a screen share. But basically, what we try and do is if you're running Ninja and you've got like 500 other things installed and it's not working, we won't say it's Ninja and leave you to it. We'll actually get on the screen share and we'll try and, figure out what's wrong. Because basically it's just, I've been in that situation where I get passed from one person to another person and back to the other. It's like being a support ping pong ball. You can use Ninja ATM orders in Jigsaw, no problem at all, but you can't do it with the NT Direct version. And we will soon be having our own ATM orders built into the Jigsaw product too. Okay, so I think we're good. I think we're probably out of questions right now. So I'd like to say thank you guys for coming in. I do appreciate it. I do really appreciate the guys that you come in and you all stay to the end. So I'd like to thank you for coming, and you've got my email address, peterdavies@jigsawtrading.com. Feel free to email me. My Skype ID is Jigsaw Trading. Feel free. Yeah, if you want to if you come to Thailand, certainly come and Skype me and we'll get together and we'll go for a beer or some lunch. But feel free to get in touch, and I do like to talk to other traders, so feel free to have a chat as well. So thanks a lot, and good night.